Every major technological revolution, from the dot-com era to crypto and now AI, follows a remarkably consistent pattern: an initial explosion of innovation, followed by a massive influx of capital, unchecked speculation, inevitable market crashes, and only then, the arrival of comprehensive regulation. This cycle is not a bug, but a feature of disruptive progress. In the mid to late 1990s, the internet's nascent stages were deliberately left largely unregulated by Congress. Instead of restrictive laws, enabling legislation was passed, fostering an environment of rapid growth. This included opening telecom markets, protecting platforms from liability, creating copyright safe harbors, banning internet taxes, and legalizing digital contracts. These measures prioritize scale and innovation over immediate consumer protection, leading to an unprecedented boom where Nasdaq soared and valuations detached from fundamental realities. The bubble eventually burst between 2000 and 2002, with Nasdaq plummeting nearly 80%, thousands of companies failing, and many declaring the internet dead. Yet, the internet itself thrived. Only unsustainable business models perished. A forgotten detail from this period highlights the resilience of true innovation. Amazon, widely mocked and written off during the crash, traded at roughly 25 cents per share, split adjusted. A $10,000 investment then would be worth over $8 million today, not because regulation saved it, but because the crash transferred ownership from the impatient to the patient, allowing long-term vision to prevail. This brings us to crypto, a phenomenon that mirrored the internet's early days, but at a significantly accelerated pace. Like the internet, crypto emerged onto the global stage without clear rules or established frameworks. It was a wild west of digital innovation, attracting a diverse array of pioneers and opportunists. Regulation, when it eventually arrived, did so primarily through enforcement actions rather than through carefully crafted legislation. This reactive approach meant that the rules of the game were often defined after the fact, creating an environment of uncertainty and rapid change. Innovation in the crypto space exploded, with new protocols, tokens, and applications appearing almost daily, each promising to revolutionize finance and technology. Capital flooded into this nascent market, drawn by the allure of unprecedented returns. Speculation reached fever pitch, with valuations soaring to dizzying heights, often detached from any tangible underlying utility. Everyone, it seemed, wanted a piece of the next big thing. But as history consistently teaches us, unchecked speculation inevitably leads to collapse. The crypto market experienced its own series of dramatic downturns, wiping out fortunes and shaking investor confidence. These crashes, though painful, served a crucial purpose. They purged the excesses and exposed the vulnerabilities within the system. Over 100 million crypto tokens have been created to date, with thousands more launching every single day. When critics declare that 99% of crypto will fail, they often misunderstand the fundamental nature of this experimental ecosystem. Even if 99% do indeed fail, that still leaves a staggering 1 million crypto assets that could potentially survive and thrive. Crypto can be viewed as an abundance experiment where failure is not a flaw, but a built-in feature. It's a continuous process of trial and error, where only the most robust and valuable innovations endure. In this context, regulation acts less as a killer of innovation and more as a filter, helping to separate the wheat from the chaff. It provides a necessary framework for maturity, guiding the ecosystem towards greater stability and legitimacy. This iterative process of innovation, speculation, crash, and filtering is now unfolding once again, this time with artificial intelligence. AI is currently in its pre-regulation phase, much like the internet in the late 1990s. Governments are allowing rapid progress, recognizing that AI is not just an economic race, but a critical geopolitical one. Millions of AI models and agents will be created. Most will fail, some will survive, and a few will dominate. Between 2000 and 2002, the Nasdaq composite plummeted by nearly 80%, wiping out trillions in market value. Thousands of internet companies, once heralded as the future, vanished overnight. The media, quick to declare victory, pronounced the internet dead, a fleeting fad. Yet, the internet itself did not fail. Only the unsustainable business models did. This period of intense purging was a necessary, albeit painful, correction. It separated the wheat from the chaff, the truly innovative from the merely speculative. A critical detail often forgotten from this tumultuous time involves Amazon. During the depths of the dot-com crash in 2000, Amazon stock traded at a mere 25 cents per share on a split-adjusted basis. It was widely mocked, dismissed, and written off by analysts and investors alike. The company was bleeding cash, its future uncertain, its business model questioned. Many believed it was destined for bankruptcy, another casualty of the internet bust. However, for those with foresight and patience, this moment presented an extraordinary opportunity. A hypothetical investment of $10,000 in Amazon at that precise low point would be worth over $8 million today. This wasn't because government regulations swooped in to save Amazon. On the contrary, the crash acted as a brutal but effective market mechanism. It transferred ownership from the impatient, short-sighted speculators to the patient, long-term visionaries. Those who understood the underlying value and potential of the internet and Amazon's strategic position within it reaped the rewards. This historical lesson is crucial. Market corrections, while painful, are often the crucible in which true value is forged and revealed. The internet, far from being dead, emerged stronger, more resilient, and fundamentally transformed the global economy. The dot-com crash was not an end, but a violent, necessary beginning. It cleared the path for the next generation of internet giants to flourish. This pattern of innovation, speculation, crash, and eventual triumph is not unique to the internet. It is a recurring theme in technological revolutions. The transition from the dot-com era to the crypto revolution reveals a striking parallel. Crypto followed a remarkably similar trajectory, but at a much faster, more compressed pace. It emerged without clear regulatory frameworks, a wild west of innovation. This absence of prescriptive rules allowed for an explosion of creativity and experimentation. Capital flooded into the nascent crypto markets, fueling unprecedented speculation. Valuations soared, often detached from any tangible fundamentals, mirroring the dot-com bubble. Then, just as with the internet, reality hit, leading to significant collapses. Regulation, when it finally arrived, often came through enforcement actions, rather than proactive, thoughtful legislation, creating a more reactive environment. This rapid cycle of boom and bust in crypto underscores the inherent volatility and the powerful forces at play in new technological paradigms. The lessons from Amazon's resilience during the dot-com crash offer a valuable lens through which to view the current landscape of crypto and AI. The purging of excess, the transfer of ownership from the impatient to the patient, and the ultimate triumph of foundational technologies are recurring motifs. Understanding this historical rhythm is key to navigating the future. It teaches us that innovation is messy, that speculation is inevitable, and that true value often emerges from the ashes of market corrections. The Internet's journey from perceived failure to global dominance serves as a powerful precedent for what might unfold in crypto and AI. The initial chaos gives way to clarity, the unsustainable models are shed, and the enduring technologies solidify their place. This cyclical nature of technological adoption and market maturation is a fundamental aspect of progress. It's not about avoiding the crashes, but understanding their role in shaping the long-term winners. The dot-com era's lessons are not just historical footnotes. They are a roadmap for interpreting the present and anticipating the future. The resilience of Amazon, born from the ashes of a market collapse, is a testament to the power of patient capital and enduring innovation.